In the world of business, one of the most crucial concepts to grasp is profit. Profit is the lifeblood of any company, the metric that determines whether we can keep the lights on, pay our employees, and invest in our future. But what exactly is profit? Well, it's the amount of money remaining after we've accounted for our income and expenses. It's the sum that represents what we made from selling our goods, minus the money we initially invested in purchasing them. Seems simple enough, right? But when it comes to calculating profit, things can get a bit more intricate, especially when we start diving into terms like net cost and net gain. Let's unpack the idea of net cost first. The net cost of a product or service is essentially its total cost, calculated after we've deducted any discounts, credits, or modifications that apply to that item. Think of it as the true price tag after all the adjustments. It's the number you see on an invoice, and it's a critical figure for businesses to determine profitability. Understanding net cost helps us make informed decisions when pricing our goods or services and when making purchases. To calculate the net cost, we start with the gross cost, the initial price we pay for an item. From there, we subtract any discounts or rebates we might receive. For instance, if we're buying a new machine for production, we have to consider not just the purchase price, but also any taxes, shipping fees, and installation costs. We can't forget about the training costs for our employees either. All of these factors contribute to our gross cost. Now, once we have our total gross cost, we can look at how much profit we expect to gain from using that machine. If we can generate a significant profit from the products we create with it, we can then subtract that expected profit from the gross cost to arrive at the net cost. This calculation gives us a clearer picture of how much we're really spending versus how much we're earning. In business accounting, understanding net cost is vital. It allows us to evaluate the actual cost associated with our products and services. By subtracting available discounts from the original cost, we can pinpoint our total cost, calculate our profits and losses, and assess the efficiency of our operations. This knowledge is key to maintaining a healthy financial status. Moreover, net cost plays an essential role in budgeting. When we know the accurate net cost of our goods and services, we can plan our spending more effectively and ensure we stay within our budget. This awareness also empowers us to negotiate better deals with suppliers and vendors. In short, having a solid grasp of net cost is crucial for any business aiming for long-term success. Let's not confuse net cost with gross cost. The gross cost is the total price of an item, which includes the purchase amount, taxes, shipping costs, and any additional fees. For example, when we're purchasing equipment, the gross cost might include all of those factors. In contrast, the net cost is what we're left with after accounting for any benefits we receive from that purchase. To illustrate, let's say we're investing in office equipment. The gross cost might be $1,000, but if we can sell off the equipment later for a salvage value of $200, our net cost effectively becomes $800. This simple example highlights why calculating net cost can lead to one of three outcomes. It can equal the gross cost, be less than the gross cost if benefits don't offset the expense, or it can be negative if the benefits exceed the gross cost. Now, let's touch on net price. The net price is the amount that consumers actually pay for a product after all discounts and applicable taxes have been applied. For instance, if we have a product listed at $100 and there's an 8% sales tax, the customer would initially see a price of $108. If we then offer a discount, say 10%, the final amount the customer pays would be $97.20. When it comes to invoicing, it's crucial to understand the difference between net price and gross price. Gross pricing means the total price already includes all applicable taxes, simplifying record keeping for both the customer and seller. On the other hand, net price invoicing allows businesses to bill consumers after applying any volume discounts, streamlining the process and ensuring accuracy. So, what should we use when creating invoices? It really depends on the business model and what our customers prefer. Some might appreciate the clarity of gross pricing, while others might want a breakdown of costs to understand where their money is going. The key is consistency. We need to ensure that whatever method we choose, we apply it uniformly across all our accounting records. Now, let's talk about the advantages of computing net costs. One significant benefit is discount tracking. By monitoring which discounts are most profitable, we can adjust our strategies accordingly. If we notice that many customers are forfeiting discounts, we might consider lowering the criteria to boost cash flow. Conversely, if discounts are being overused, we might tighten the terms. Another advantage is accuracy in inventory costs. The net price method helps ensure that we accurately record inventory costs, regardless of whether customers take advantage of discounts. This accuracy is essential for maintaining proper financial records and ensuring that we're not overestimating our inventory value. When it comes to accounts receivable, understanding net cost helps us maintain correct balances. If a customer fails to pay an invoice within the discount window, we need to adjust our records accordingly to reflect that loss. This practice helps us keep track of overdue invoices and lost sales discounts, which is vital for maintaining a healthy cash flow. Now, let's shift gears and discuss net gain. The net gain is a measure of the profits or losses over a specific period. It's calculated by subtracting all costs associated with an activity from any income earned during that same time frame. A positive net gain indicates profit, while a negative number signals a loss. This figure is crucial for measuring the profitability of our business and comparing different investments. When we evaluate the financial performance of a business, it's essential to consider both net cost and net gain. The net cost tells us what we spent on a particular investment, while the net gain reveals the benefits we derived from that investment. For example, if we spend $500 on a marketing campaign and it generates $1,000 in revenue, we have a net gain of $500. This comparison helps us determine whether our investments are worthwhile and informs our decisions on resource allocation. In conclusion, understanding net cost and net gain is essential for any business aiming for success. By keeping track of our costs and income, we can make informed decisions that maximize profitability. Whether we're calculating net costs to evaluate our expenses or measuring net gain to assess our profits, these concepts are vital for maintaining a healthy financial status. As we navigate the complexities of business finance, let's remember that a solid grasp of these terms can empower us to make better decisions and drive our companies toward long-term success. After all, in the world of business, knowledge truly is power.